Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing ZIM stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 2.7 billion market cap. They're trading at $23 a share and they have 120 million shares outstanding. ZIM is an Israeli cargo shipping company. They're one of the leading carriers in the global container shipping industry. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow was unbelievable in 2021, $5 billion. It got even better in 2022, $5.8 billion. That's why everybody was buying the stock and it went up so much. Then it came way down to $900 million, down 84%. But it is rebounding. They had a good first quarter, $1.1 billion in the trailing 12 months, up 18%. Net income is the profit or loss on the income statement. It's revenue minus expenses. $4.6 billion in 21 and 22. A really big negative in 23 in the trailing 12 months due to write-downs. They were cash flow positive. They have so much fixed assets on their balance sheet, the vessels, they often have to write those vessels down on their balance sheet and pass through a loss onto their income statement. But that's a non-cash item, so it doesn't affect cash or dividends. Revenue is a sales for the company, and that grew to $12.6 billion in 2022 because of high shipping rates. Shipping rates came down, so did their revenue to $5.2 billion. But there is hope. It's getting better. The last few months have been pretty good for shipping rates, and of course shipping companies. Revenue is up to $5.4 billion. Their revenue per share is double their share price. That means their price of sales is a 0.5. They just brought back their dividend after eliminating it. Now it's 1%, but they're going to probably raise it if they keep bringing in all this free cash flow, because it only cost them $28 million, and they have over $1 billion of free cash flow. We estimated 4 years of future free cash flows. We also estimated the terminal value, it's all cash flows past year 4, that's $9 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $7.6 billion. We divide that by 120 million shares. And we get a calculated stock price of $63. They're trading at $23, so they're trading at a 64% discount. It's a strong buy according to the model. There are 31 companies in the same industry as ZIM, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx. Most of their CapEx is the acquisition of vessels, only $88 million. They do have a pretty bad debt-to-equity ratio. For every dollar of equity, they have $2.10 of debt. They brought their dividend back, so it's still pretty small at only 1%. Free cash flow of $1.1 billion. Which is a lot of free cash flow for a company with 2.7 billion market cap. They're trading at 1x book value. We can't look at their PE, they have negative earnings. And they're trading at 2.5 times free cash flow, which is a great multiple. Grindrod is the best, 1.8. They have the best price of sales. They generate the most revenue out of any company in this industry. And Kirby is 2.5 times larger. If you put $10,000 into this company when they started trading, you'd be in the green the entire time. At one point, you'd be at $70,000. But if you're still holding on, you'd be at $44,000 today. That's a 56% annual return. Let's take a look at their first quarter financials. We'll start with their income statement. Revenue is up $1.56 billion compared to $1.37 billion last year. All of 2023 was $5.2 billion. So if you annualize the first quarter of 2024, it's over $6 billion. And gross profit is up a lot, up about 4x, $54 million last year. Their operating profit is $167 million compared to a loss last year. So it's a big improvement. Net income is $92 million, a loss of $58 million last year. And of course, their EPS is a lot better, 75 cents compared to negative 50 cents. And for all of 2023, the loss per share is $22.42. Their current assets are $2.5 billion. Current liability is also $2.5 billion. So current ratio is pretty close to a 1, a little under a 1. Their assets went down a lot. It was $11.5 billion, now it's $9 billion. It looks like they sold a lot of investments, $1.3 billion last year. Now it's 800 million. Their cash also went down a lot, from 1.9 billion to 700 million. Liabilities are 6.4 billion. Lease liabilities, this is how much money they owe on lease payments, because sometimes they lease the vessels instead of buying them outright. They also own 3.7 billion on lease liabilities for non-current. So if the lease payment is due beyond 12 months, it's part of this non-current part. Assets minus liabilities equals equity, 2.5 billion of equity. That dropped a lot from last year of 5 billion because of all those net losses on their income statement. Let's take a look at the statement of cash flows. Operating cash flow 326 million, up from 170 million. So that's up about 90%. And all of 2023 was 1 billion. They're on pace for 1.3 billion since they got 326 million in the first quarter. In their investing section, they had a cash inflow of 180 million. This is from the sale of investments. They also spent 24 million in acquiring CapEx. That's mainly vessels. They had a cash outflow of 741 million in their financing section. Most of that was repayment of debt or lease liabilities. Here's a breakdown of their revenue, the 1.6 billion. Revenue from vessels that went through Pacific routes, 609 million. Cross Suez, 185 million. The first two are up, but Atlantic is down. It went from 217 million to 165 million. Intra-Asia is also down. Latin America is up a lot. That was 92 million, now it's 147 million. Revenue from shipping vehicles, 111 million. That's up a little bit. Other revenue, which is demurrage and other fees, 221 million. They give a nice breakdown of operating expenses. This 1,080 is on the income statement. You see it's right here under revenue on the income statement, 1080. That's how you get your gross profit. You take your revenue minus your operating expenses minus depreciation, gives you gross profit. And this 1.1 billion is made up of a lot of expenses. 457 million of expenses related to cargo handling, because they have to pay a lot of people to move the cargo on and off the ships. Bunker and lubricants, 307 million. That's the gasoline or fuel to make the ship move. It's kind of like when you put gas in your car, they put bunker fuel, or they call it lubricants, into the vessel. Port expenses, 113 million. There are different fees like docking fees, inspection fees, handling the cargo. Then you have the salary for the crew, 50 million. Services and sundry. Sundry is like miscellaneous expenses. That's 90 million. They have to purchase slots at the different ports, 29 million. Their shares outstanding haven't really changed much. It was 120 million in 2023, also 120 million for the first quarter of 2024. Let's look at their presentation slides. 2024 expected to be better than 2023. That's good news. Revenue for the first quarter, 1.6 billion, 427 million of adjusted EBITDA, 167 million of adjusted EBIT, and adjusted EBITDA margin 27%. The way you calculate that, it's adjusted EBITDA over revenue. Adjusted EBIT, which is adjusted EBIT over revenue, 11%. So the difference is D&A, depreciation and amortization. So this implies depreciation and amortization equal $260 million. So the difference between these two numbers. Operating cash flow up 88% to 326 million. 2.25 billion of total liquidity. Equity, 2.55 billion. Equity is assets minus liabilities in the balance sheet. They increased their 2024 guidance. Adjusted EBITDA is between 1.1 and 1.5 billion. Their 2024 guidance was a lot lower last quarter. Adjusted EBIT between 0 and 400 million. And they paid a small dividend, 23 cents. It only cost them $28 million, which is 30% of their net income. Those big boxes on the vessels, they're called TEUs, 20-foot equivalent units. That's how you measure the size of a ship, by how many TEUs can fit on it. In the first quarter of 2024, they carried 846,000 TEUs. And the freight rate, the amount they charge for carrying a TEU is $14.52, which is up 4%. Cargo carried is up 10%, revenue up 14%, because they carried more cargo and charged more for each unit carried. They have 147 vessels, 131 container ships. These vessels carry those big containers, and they have 16 vessels that just carry cars. They have 10 vessels that carry 15,000 TEUs. Those are the big vessels. These are probably Cape-sized vessels, and they're LNG fueled, so they're more efficient, liquefied natural gas. These 46 vessels in this box are the new vessels they bought either last year or this year. All 10 big vessels have been delivered. 4 12,000 TEUs were delivered. Half of the 18 8,000 TEU vessels have been delivered, 9 delivered. This year there's 21 vessels up for renewal. Next year 37 vessels. Revenue is up 14% this quarter compared to the first quarter of 2023. But when you compare this quarter to last quarter being the fourth quarter of 23, revenue is up 30%. Last quarter and the first quarter of 2023, negative net income. Now it's almost 100 million. They delivered the most TEUs in the Pacific, 348,000. The second biggest was intra-Asia, then Atlantic, then Latin America, then cross Suez. Latin America has grown a lot. It was only 51,000, now it's 116,000. But these three declined when you compare 1Q23 to 1Q24. Their cash went down 430 million. The way you calculate that, it's operating cash flow 326 million. They spent 23 million in capex. That gives them free cash flow of 303 million. They paid 740 million to service their debt, the interest payments. So that gives them net cash of negative 430 million. 303 minus 740. Then this positive 7, which I'm not sure what it is. Here's the most important chart, the freight rates. So if we just look at one, South America, this green line is freight rates for 2024. And rates are getting kind of high. They started off low, but they more than doubled. 2019 is on the bottom. Rates were low all throughout 2019. 2020, the purple line, was real low the first half of the year, and then it really jumped up. That's right in the beginning of COVID, the second half of 2020. 2021 was this line right here. Really great time for shipping companies. Rates were really high. Companies like this were paying massive dividends. 2022 started off good, but then the second half of the year came way down. It's right here, the end of 2022. 2023 was the orange line. Rates were really low the whole year. And 2024 started out low, but it's looking really good. Global volume, the number of TEUs that are moved across all shipping companies. The purple line is 2024. So you can see it's at a pretty high level in March. January and February usually start off pretty low. February is usually the worst month, but then it picks up as the year progresses. Here's how you calculate EBIT and EBITDA. Remember earlier I said depreciation and amortization has to be 261 million right here. So to calculate EBIT, it's earnings plus IT. I is interest right here, financial expenses, that's interest, and T for taxes. So we take the 92 million, add back interest and taxes, we get 167 million of EBIT. EBITDA is earnings plus ITDA. I is interest, T is taxes, DA is depreciation and amortization. ITDA. 92 plus 70 plus 4 plus 261, that gives you EBITDA of 427 million. A lot better than last year. Last year, negative EBIT. They did have decent EBITDA, but it did improve. It went from 370 million to 430 million. I wonder why depreciation was so high last year. Did they get rid of that many ships? I don't think so. That's something to look into. Let's look at a company on Simply Wall Street. Its last price 23, 2.7 billion market cap, up 7% in the past week, up 59% in the past year. Let's see what they say about the company. ZIM provides container shipping and related services in Israel and around the world. It provides door-to-door and port-to-port transportation services for various types of customers, including end users, consolidators, and freight forwarders. They also offer ZIM Monitor, a premium reefer cargo tracking service. Reefer is not cannabis. Reefer means refrigerated cargo. As of 3/1, it had 150 vessels, which included 134 container vessels and 16 car vessels. It operates a network of 67 weekly lines, incorporated in 1945, headquartered in Haifa, Israel. They just started trading a little over 3 years ago in February 2021, and they started out at 15, and then there was a huge craze on this stock. It got up to 88 just 13 months after IPO. And I know a lot of people lost money because they bought when it was north of 60. You generally don't want to buy a stock when it's trading on its all-time high. 18 months after hitting its peak, it bottomed out at 659. That was in November 2023. It was hard to buy the stock when it came down to these levels. Some people were saying it's a scam company, don't buy it. But the stock tripled since then. Now it's trading above 20. Simply Wall Street's valuation is 25. They say it's 11% undervalued. 6 analysts priced this stock at $12. They say it's nearly 50% overvalued. The revenue forecast for 2024 is $6.3 billion, $5.4 billion, $5.3 billion. So analysts are projecting declining revenue. The free cash flow forecast looks pretty dismal. Under $500 million in 2024, only $400 million in 2025. Their revenue was only $3.7 billion in 2013. And for 7 years, it was pretty much flat. It didn't really go up much. Then shipping rates got real high and they bought a lot of vessels, and their revenue went to $14 billion. It did come down, but it's still trading about 50-60% higher than pre-COVID levels. They're paying their next dividend on June 10th. The ex-dividend date is June 3rd. Here's their dividend history since they started trading. They started out at a 16.5% dividend. And if you bought the stock when they announced this big dividend, you could have made your money back in the stock twofold just in dividends, because it went from 16.5 to 60, then in May 2022, 60 again, August 60 again, November 60 again, then 87%, and they're still paying it. And then it dropped to 3.5%, then they cut their dividend, but they brought it back. Half the companies owned by the general public, 3/10 by institutions, 1/5 by private companies, and 1/100th by insiders. Their biggest shareholder is Cord Investments, then Ion Asset Management. That's an Israeli asset manager. Susquehanna, Menorah, BlackRock. Menorah is the BlackRock of Israel. You see Goldman, D.E. Shaw, J.P. Morgan. Their employee count went from 3,800 to 4,800. And the ticker trades on the Deutsche Börse and New York Stock Exchange. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.